Hello and welcome to Currency Exchange, NatWest Markets podcast, where myself, Eimear, Daly, and our team of FX strategists help to break down the major themes and events driving FX markets this week. For this week, it was the bumper UK data week, where we had the triple whammy of UK inflation, UK labour market, and we are eagerly awaiting UK retail sales data out tomorrow. Today, I am joined by our head of FX strategy for Eimear, Robson, who's going to help us to break down the major developments and what that actually means for sterling. I'll start first with the labour market report, and it was a cracker. Unemployment rate stayed unchanged at 3.7%, only 0.2 percentage points off a 5-decade low for the unemployment rate, and we had 74,000 jobs added to the UK labour market in the 3 months to December. So that is the highest level for 6 months. Paul, what did you make of this data? And I guess most importantly, what do you think it means for sterling?
Well, I think in terms of the labour market data, it was a very solid report. I think markets weren't expecting the kind of jobs growth that we got. So that's obviously a positive, maybe just leans against some of the more pessimistic views around the UK outlook. If people have their jobs and they're getting paid more, then they can lean against this sort of cost of living crisis. Underlying average earnings was a little bit stronger, so we had that dip down in sort of headline. But once you strip out bonuses, you've got some relatively strong wage growth there. And when you think about the Bank of England, it's about the persistence of inflation and whether they need to deliver another 25 basis points or even back-to-back 25 basis points, and a little bit more wage inflation obviously plays positive for the currency through that. There was obviously the CPI numbers as well. The biggest reaction for the currency came from the drop in inflation. For me, it was the core number that was really very weak indeed. I was just getting to the point where I thought the economists were getting a better handle on forecasting inflation globally after some of those big surprises of last year. But the number that we got this week was outside of the range of forecasts, just like employment in the US. So it's obviously matters. But listening to our economists, they do make the point that the downside miss was very concentrated on and centered on a couple of components. The most obvious one was footwear and clothing, which is probably a function of discounting in the winter sales. And additionally, we didn't think there was actually that much discounting. So that probably suggests that the numbers revert back to underlying trends next time. Weakness in transport as well, airfares. And so when we look at the report overall, it's not really pointing to a broad-based weakening inflation. So we think the market might have reacted a little bit too much for that release. So we think that will fade. For sterling, looking out, I mean, we still have this non-consensus trade or view on the currency, that the currency outperforms a very sort of pessimistic market expectations. So we think that sterling dollar, for example, gets to 130 sometime during mid-year. We also think that sterling is too low against the euro. So we are expecting sterling euro to move higher, euro sterling move lower. We see this in the lens or through the lens of our three sort of themes for 23. So regular listeners will know that we've talked about European energy prices, China reopening, and the US macro. We think that it's the energy price story that matters most for sterling, because it reduces or shifts the balance of risks around the UK outlook for growth, inflation, government borrowing, the balance of payments. And we don't think that that's fully reflected in current sterling valuation. We think markets will need to revisit their views of the balance of payments and also how the risk premium applied to UK assets is adjusted. The outlook is set to be weak, but I think the risks have shifted from having been massively to the downside to more balance, or actually to squeeze some of the market narrative.
Yeah, I think that's a great point that the market seems overly bearish on sterling. And I'd have to say, you are kind of sterling bull. We got quite counter consensus. And it's definitely something that stood to you through Q4. Why do you think, markets have this kind of big great need to be pessimistic on the UK, on UK assets? And what are they underestimating here? Is it, the impact of energy prices falling? Or is it they're too focused on Bank of England policy?
Yeah, I think you're being, quite charitable in your comments there. It's a very sort of non-consensus call. I sometimes describe it as a popular view as a rattlesnake and a lucky dip at a country fair. Obviously, not very popular indeed. But I think that's actually part of the important narrative around it. Is expectations are so sort of negative for the UK that it's fully in the price, and that it's going to be hard to see who the sort of marginal seller of sterling is if that's already in the price. And you see it in the way markets react to sort of headline news like the IMF becoming quite pessimistic about the UK economy, coming up with a sort of 1%-ish fall in GDP for this year. But markets have been pricing that for the best part of 6 months. And it is not new news, and that's important as well. Where I also think that market might have it wrong is that they're so focused when it comes to yield and the Bank of England outlook is this idea of yield differential. And yield differentials are important for currencies. But when you think about what markets were worried about for last year and how it's changed, they were worried about a housing market collapse, a sort of over-tightening of policy because of inflation. But now that you're going to get a less amplified policy cycle, mortgage rates are coming lower. And so the risks around that sort of slowdown in growth or in the housing market are nowhere near as much as they used to be. And therefore, the people who used to have a negative view on those things just haven't seemed to have ridden it back. And so the markets see a sort of smaller or less tightening of monetary policy as a negative, whereas I actually think it should be seen through the lens of the risk premium. The other and final point, I think it's the balance of payments. In currency markets, I don't think on a day-to-day basis people look at the balance of payments trends in a lot of detail. But if we're right and the energy prices come lower, then the fuel balance for the UK is going to be sharply different. And what we've observed at NatWest is that the relationship between sterling against the dollar tracks market forecasts of that deficit. So I think over time, markets will adjust their view of the balance of payments position, growth, and that better mix will squeeze those negatively held views in the market.
Mm-hmm. I just say, as an emerging market economist, I feel like you can't underestimate the importance of your trade balance. It's such a fundamental and persistent flow of either, outflow from your currency if it is a deficit, or inflow if it is a surplus. So I do think the correction we're seeing, and we're definitely seeing that playing out across kind of Central Eastern European economies, is fundamental. And like you say, that key trigger of energy prices. Given what you're saying, that everyone is so pessimistic on sterling and kind of underpositioned, I guess, in UK assets, what's the trigger? What is the trigger for them to get back in long sterling local currency assets?
Well, I think it will be a sign that the sort of negative view of the currency isn't playing out with the currency. So there will be signs of fatigue in markets. I think some people will have as time decay way against positions. I think that's going to be important, because that will be a sign that the balance of payments position is in fact changing, that you're getting a much more balanced outlook for the economy. I think that's going to be important. I think once markets get a little bit more confident about the balance of payments trends as well, so they're watching those forecasts of the deficit for this year, once they start to narrow further, I think that will be a trigger as well. So really just watching how the sterling trades against the backdrop of the current account, and also watching how economists view the balance of payments, because ultimately, currencies are driven by the net flow of money into an out economy, and that, as you quite rightly said, is the balance of payments. I just think that that's an unappreciated theme in markets at the moment.
Yeah, absolutely. So watching trade flows. Paul, I cannot let you go without asking for your take on this week's US inflation report. It was slightly higher than expected, but I felt like the US dollar wasn't exactly sure what it actually made of it. What did you think? And what do you think of the market reaction?
Yeah, well, I think the market reaction was right. I think that it was a bit of a nothing report. It didn't embolden people to look for a more hawkish Fed, nor did it lean in favor of them continuing to roll back their guidance. I actually think the biggest thing for the dollar this week has been more about the activity data that we're getting. So the last couple of weeks, employment, ISM, retail sales are all sort of leading to the idea that the US economy started this year a little bit more strongly than markets had expected. And talking to my colleague Brian about how he's seeing it, it's about resetting the timetable on that changing guidance from the Fed, from sort of more hawkish to more dovish, that point in the peak interest rates in the cycle. And you sort of reset that. So you now need to see a couple more months of, say, softer data for the Fed to be a little bit more confident. I mean, the way I'm thinking about it is it's like the game of stakes and ladders that we sort of played as a child. You sort of, the Fed's moving up the board with every piece of weak data. Sometimes the data is very weak and you maybe go up a ladder. But occasionally you get these strong pieces of data and you come down a snake and you're at the bottom of the board again, and you have to work your way up the board again. And I think that while they're doing that, it's a more positive dollar environment. I have to say it's sort of leaning against our core view to be short dollars. So we are a little bit more watchful, a little bit more careful on the dollar right now.
Yeah, they are definitely high up that ladder right now in terms of just how strong the US data and how high the Fed may have to take rates in order to counter it and cool down growth. Well, guys, that is all we have time for this week's edition of the Currency Exchange. Just to thank Paul Robson again for joining us and taking us through the UK data and obviously our counter consensus bullish sterling view. If you did like the podcast, please let us know and take a like and make sure to subscribe so you can get the latest episode of Currency Exchange first. Thanks, guys, and thank you for joining us.